Let's chat about the markets and more with Digant Haria, the co-founder at GreenEdge Wealth, who's joining us live today. Good morning. This is Nantara. So, first I'll begin my conversation with you, Digant, with to get your views on how you're navigating the volatility, the kind of uncertainty that we're seeing thanks to the geopolitical tensions. Look at crude, triple digit, $116 a barrel is here. What is the advice that you've given to clients? Is it time to take cash off the table?
So see, last 2 years, all the export-oriented sectors in India did really well. The commodities, the IT, the chemicals, the pharma, because the globe was doing well. India was not doing so well domestically. I think now, with whatever is happening around the globe, it's getting clear that, India-focused businesses could probably be a little better because they will not be hit by whatever is happening. But yes, oil being at where it is, metals being at where it is, India is a big consumer of all these commodities, so it can never be good for India. Like most of our colleagues, we are also watching the market. We are just watching where this uncertainty ends. And whenever this uncertainty ends, see, crude cannot remain above 100 for a very long time, nor can metals remain at these prices. So whenever they end, I think there are great companies out there which will be available at good prices. Like last 2 years, we did not see much corrections. We are hoping some of the great companies come at good prices, and we'll just buy them because the Indian domestic economy has a very good runway. Once all these macro headwinds subside, so that's how we are also looking at it.
Now, Digant, if you look at the banking sector at large, how it started off the year, it was looking like this is going to be the year of the banking stocks that had underperformed. But, it's early March and things seem to be changing, where once again the play seems to be for the defensives, the rotation that's taking place back towards IT, pharmaceuticals, etc. So, your opening comments on the comeback of the banking sector, which seems to have hit a pause button at the moment.
See, I think, Nandara, that firstly, one thing is absolutely clear to everyone now that the last decade, most of the banking sector was embroiled in the NPA crisis or the asset quality crisis. But it's now getting very, very clear that, we are past that stage. We really, the reforms like the IBC, the GST and this ILFS and COVID, we had multiple rounds of cleanup which have happened in the banking sector. So balance sheet is really, really clean. In the previous interview which you telecasted, the Prashant Jain also said that the balance sheets are really clean. I think that is really well acknowledged by the market. You saw a very big rally in November 2020, and banks like ICICI, SBI, Canara Bank, they went on to make new highs because it is getting clear that asset quality is no longer a big issue in the Indian banking sector. So that had the first round of re-rating which happened. But see, when foreigners invest in India, when we also as Indians, we invest in an Indian company or an Indian sector, we are looking for growth. India, if it is any company or sector is just growing at 7-8%, that sector cannot re-rate because India is a growth market. And what is happening with the banks is that growth is really, really languishing. So if you look at the system credit growth, it's hardly 5 to 6% in the last 18 months. SBI is struggling to give more than 10% credit growth. Federal Bank is struggling to do that. Though HDFC and ICICIs of the world are delivering that higher growth, but there are only 3 such banks which are giving you more than 10% growth. So my belief, Nayantara, is that in an environment like this, where growth will not exceed 10%, it is very, very difficult for the banking sector to re-rate. Yes, the risk in banking sector is extremely low because asset quality is not an issue. But now, I would go as far to say that in this coming decade, growth is going to be the next big risk for banks. So last decade, it was always the asset quality. We gave great valuations to HDFC and Kotak Bank because they were one of the few banks who could maintain good asset quality. But now the next 5-10 years, the challenge will be who can grow as well. So that's the reason why the banking sector is underperforming. I will now, come to three different reasons why the growth in banking industry is very, very low, and why it will not be very easy for this growth to pick up in the next 6 to 12 months. So the first and the foremost reason is right in front of our eyes, that because of COVID, because of this lockdown, the second wave, there is only 1 or 2 crore affluent families, probably families like us, which have not lost our jobs, which have probably got salary hikes, and we have enjoyed the stock market boom. So this 1 2 crore families are doing extremely well, and their consumption is doing extremely well. But when you come to the next 5 to 6 crore families, people who were employed in the malls, in the restaurants, in the aviation sector, in the taxi services sector, I think all this is yet to come back. Their incomes have been meaningfully butchered, and we can see that happening in the volume growth that we see for a Hindustan Lever or a Hero or a Maruti, or these kind of the low level entry level products. So an SBI or an ICICI or an HDFC, the banking sector is a very large sector. Banking represents India. So if there is a large part of the banking system, of India, which is not doing well, that is getting reflected in the banking sector as well. Because the next 5 to 7 crore families are not borrowing. The SME businesses are in pain. They are not borrowing in a big way. So the only lever for growth right now is the affluent retail, like people who want a larger home, or somebody who wants a personal loan. So I think the market has become narrow, and growth is going to remain challenged. So that's my reason number one. Reason number two is that, see, in the last decade, we have punished companies
Digant, we
which
got
have
the point.
taken debt.
Digant, we got the point. I just wanted to understand that our viewers have seen you in earlier avatar talking about NBFC insurance space. Let's avoid the insurance space for now. But NBFCs, what do you think has happened now? Most of the NBFCs have also cleaned up, raised cash, reduced cost of funding, but still the markets are not rewarding them the way they used to do in 2017-18.
Yes, because see, you are absolutely right. The NBFC balance sheets are also very clean, but you look at most of the NBFCs, you look at Canfin Homes, you look at Muthoot Finance, you look at Shriram, they're all trading at like 10 12 times earnings. And like in the last decade, they could easily get 15 20 times. So the reason is that when growth in the system is very limited, it is people like HDFC Bank and ICICI Bank who have the lowest cost of deposits. They are eating away the business of these NBFCs and even the lower rated banks. So a City Union Bank was considered to be a very niche and a unique bank, but today HDFC Bank is going right into the hearts of Tamil Nadu and taking away the customers by offering lower rates. So let's just say that the cake is not increasing, and everybody wants to eat that cake. So HDFC, ICICI, Axis, SBI, with all their deposit cost might, are attacking this space. And there is very little left for these guys to eat. So I just think that you look at Shriram Transport, fantastic balance sheet, fantastic credit cost numbers, the best probably in last 7 years, but growth rates 7-8%. Indian markets don't get excited on that 7-8%. So again, the reason is same, that there is no growth in the system, and which is probably the one big reason for this underperformance. Second is that all these startup ecosystem, the InVIT ecosystem, that itself is eating away slowly and steadily. I wouldn't count that as a big competition right now, but when growth is low, they are also even the small leakages which go to the startups and to REITs and InVITs, they also matter. So that's the second point. And third is that, see, in the last decade, we have punished everyone who is growing very fast. We have punished everyone who is taking a lot of risk. So the CFOs of any corporate, they will think not twice, they will think 10 times before taking debt. And that is why we are seeing that most of the capex are also happening without really taking a large amount of debt. So that's a psychological shock. We've seen that happen with public sector banks, that when CVC and CBI inquiries happened to the public sector bankers, they did not lend for 5-6 years. They're still not lending now in a very big way.
Right.
So I think it's a combination of these three things.
And Digant, actually, when we had this knowledge session with you just last week, we were talking about LIC in great detail and the valuation, and you explained that it's an art, not a science. But I just want to understand, with the latest news of the IPO being postponed, the moves that we've been seeing within the insurance space as well, take us through your outlook on the valuation and what it means for the insurance sector as a whole? Any picks here?
LIC IPO was much awaited. It would bring a lot of new equity investors and probably, it would improve the governance in the largest institution in India. So obviously LIC being postponed, it should not come as a big surprise because, when markets are in such a volatile phase, when foreigners are selling stocks like HDFC, without consideration for price, it's only natural that LIC will not get the kind of response that it deserves. So government may be right in probably postponing the IPO. And then see, the price, LIC is trying to sell a lot of its stock to the policy holders. So if you're selling that stock there and if the stock does not do well, I think it will just create a negative feedback loop. So it's better that the government also waits for better market conditions and things can become better for LIC if it does it next year. That's more on the technical and the listing part. But as far as fundamentals are concerned, I think LIC should be valued between 1 to 2 times of embedded value because of what we've discussed in the past, that LIC is the strongest player in traditional products, but they have no presence in the new age insurance products. And it is the new age insurance products which are really creating the big profit pool. So in that sense, LIC has a lot of hard work, like just 6 months, it cannot do all this. But over next 2, 3, 4 years, if it is able to launch new products, I think private sector will face competition. But see, we have always seen that private sector innovates even more. When public sector banks innovate, private sector will innovate even more. So I don't see a very big reason for the public sector insurance companies to lose market share. I think their market share gains will continue, but maybe it's 1 or 2 years of that uncertain phase where people will allocate some money from HDFC Life to an LIC because LIC is too big to ignore and because LIC is cheap. But I think beyond that, a year of adjustments, I think these companies, the private insurance companies, will also compound. They have also not gone anywhere in the last 2, 3 years, primarily because of the lack of demand and the COVID pressures on their payouts. So yeah, I think the sector as a whole, will remain slightly uncertain till LIC IPO is over. But once LIC IPO is over, we will get to know the direction that LIC is taking on its business and the other private insurance companies on their business front.
Thank you very much, Digant. Pleasure chatting with you as always.